welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Every expert on TV has one thing in common: hindsight that sounds like foresight. Artificial intelligence, because regular stupidity wasn't scaling fast enough. Travel is the only thing you buy that makes you richer, until you check your credit card bill. Reality TV is proof that evolution sometimes takes a coffee break. Science gave us flight, vaccines, and AI. We used them for cheaper vacations, fewer shots, and cat filters.
This is India's quiet but powerful economic shift over the last decade. Back in 2011-12, services already dominated about 60% of the GVA. Fast forward to 2023-24, and that number has climbed up to 63%, cementing services as India's undisputed growth engine. What's driving this? Trade, transport, communication, financial services, real estate together, and together they make up nearly half of India's economic output. Digital boom and urbanization wave have clearly punched above their weight. Meanwhile, industry stays steady at around 26 to 28%, with manufacturing holding its ground as a key employer and export driver. And the primary sector, agriculture and mining, has slipped from 18.5% to 15.4%, reflecting India's long-term structural transition. This current rally of gold does not really feel like a bubble. It feels more like the chapter 3 of a very old book. The first great gold cycle from 1971 to 1980 delivered a staggering 2,330%, mostly on inflation fears. The second, from 2001 to 2011, gave a 640% return on deficits, geopolitics, and the financial crisis. And today, from its 2018 lows, gold is up just 120%. Tiny by historical standards? Quite so. If past cycles are the map, we are barely out of the driveway. These two charts from the Bank of England show something unusual. US market correlations with the dollar have stopped behaving the way textbooks say they should. On the left, equity indices like the S&P 500 and the Russell 2000, which normally fall when the dollar rises, have become far less negatively correlated since early 2025. In some weeks, they're even moving together. That's a classic sign of hedging flows, weak data, tariff noise, and risk repricing pushing both stocks and the dollar down simultaneously. On the right, the 10-year US Treasury yield has also been losing its grip on the dollar. Rate expectations aren't steering the currency the way they used to be. Instead, capital is hedging US assets, creating temporary downward pressure on the greenback. But here's the twist. Given the macro backdrop, the dollar should have weakened much more, and it hasn't. That tells you that the underlying demand is still strong. Higher US rates, better growth, and the dollar's reserve role remains intact. This chart shows a rare moment in market history. India is now trading at its biggest valuation discount to the US in 17 years. The Nifty sits at 23.4x earnings, while the S&P 500 is at 28x, a gap that used to run the other way for most of the last 2 decades. So what changed? Two things. Foreign investors have been steady sellers of Indian equities, and the US has been turbocharged by an AI-driven rally that makes everything else look cheap. Meanwhile, Nifty's earnings per share in dollar terms has slipped 2.5% over the past year. Not a disaster, but enough to deepen the discount. Historically, India tends to outperform after deep valuation gaps, especially when earnings stabilize and domestic flows stay strong. So, how have the world's largest economies done over the last decade? These are inflation-adjusted real GDP numbers, and the results are not subtle. The US grows at a solid 28%, showing why it remains the world's economic anchor. But the real fireworks are in Asia. China jumps 74%, expanding by over $8 trillion, basically adding a Germany and a Japan to its economy. And India, it tops the chart with an incredible 77% surge, rising from $2.4 trillion to $4.3 trillion. That's the fastest growth amongst all major economies. Meanwhile, Europe's gains are modest. Germany at 10%, Italy at 11%, France at 12%, steady but hardly explosive. Japan grows just 6%, reflecting its demographic and structural constraints. This is a very important lesson. Equity markets don't grow in straight lines, GDP does. On the left, over the long run, India's GDP and the Nifty 50 move together. Growth compounds, companies expand, markets rise. Simple story. But the two panels on the right show the messy reality underneath. There were 9 full years from 1994 to 2003 where India's GDP grew more than 12%, but the Nifty basically delivered zero. And again from 2007 to 2013, GDP rose over 15%, while the market crawled at 0.4%. That's the non-linear nature of equities. Long stretches of boredom, frustration, and why do I even invest? Followed by sudden bursts that make up for everything. A look at India's mutual fund industry. Total equity AUM stands at a massive 35.2 lakh crores, up 4.38% in a single month, and the top five remain the usual giants: HDFC, SBI, ICICI, Nippon, and Kotak. Fun fact: Nippon is the only one of the top five without a banking distribution arm, a reminder that performance and product strength still matter. But the real action is lower down the table. AMCs like Bajaj Finserv plus 19.8%, White Oak plus 8%, Invesco plus 7%, and Bandhan plus 6% are growing faster than the industry itself. These are high velocity players gaining market share driven by boutique strategies, digital distribution, and performance led inflows. The Indian QIP market has cooled off in FY26. In FY25, 50 QIPs raised 64,750 crores, whereas in FY26, so far only 50,106 crores were raised from 25 issues. And out of that, SBI's single 25,000 crore QIP accounts for half of all the money raised. Strip out SBI, and the QIP market is running at barely 40% of last year's pace. Why this slowdown? Market volatility, stressed valuations, and corporates choosing safety over scale. That's why rights issues and preferential allotments have picked up. Firms are hunting for certainty in choppy waters. What were the top deals of the year? Biocon, CG Power, Irida, and Capri Global.